Hey guys, it's Cody here from the local home team, and I'm sitting down with
Carmelo Digrandi of BMO Nesbitt Burns.
And this is our last part of a three-part series that we're doing on investing. And again, it's not set out to say that stock markets are better than real estate investing or vice versa, but we're hoping that we can help you understand it a little bit. Again, we want to preface it with they're both get-rich-slow plans. They're not get-rich-quick schemes. And there's no right or wrong answer. It's all about your personal scenario and what suits you best. And we're hoping that we can help you decide which method is best for you today. So anyways, Carmelo, take it away.
Yes, thank you, Cody. So in the last video, we talked a little bit about TFSA versus RSP. I want to talk a little bit about how you would actually build a portfolio and what a portfolio may look like. So the most, just to keep it simple, of course, I would suggest you work with your advisor or your financial planner, but the age approach is a quick way to gut check your portfolio, if you will, to see if you're over risked or under risked. Because being under risk could be just as big of a risk as having too much exposure. That means you may not be keeping up with inflation, or you may simply not be getting the returns you need to get you to the retirement goals that you're looking for. So the age approach is simple. I'll take myself, for example. I'm 30 years old. So when you look at the age approach, you simply subtract your age by 100. So if I take 100, subtract by my age, which is 30, that gives me 70. So simply put, at least 70% of my portfolio should actually be in equities. And those are stocks, which we talked about is actually ownership in a company. The other 30% can be in your safer fixed income strategies, which are GICs, bonds, and savings accounts. So that it's a good way to gut check your portfolio really quick to see if you're over leveraged or under leveraged when it comes to your equity portfolio.
Now, would I want that balanced approach? Because I've heard typically when you're younger is when you want to be taking the higher risk. So you want the 70% in the active market so that your potential of going up is higher. If you end up losing some money, then you still got lots of time to make up those losses. Is that the reason that you want to invest more in
100%.
Yeah.
And actually, to mimic your point, I've seen this with clients and professionally before. When an individual gets started, whether they're 25 or 30, but maybe they're younger, and they've actually experienced a loss. If you've started an RSP and you've experienced a loss, I'll say the most important thing is actually to keep investing. Don't let that loss or that equity drop deter you from further investing. I've seen it happen, and it's one of the biggest fears when, in my job as your advisor, you do not want that fear of investing. When there is a drop, talk it through, understand why it dropped, how we can change, and keep your investing. Don't go the other way with it. Because then you end up in a spot where you're 55 years old, you want to retire in 10 years, and now the time horizon's so little that you have to save a huge amount of money every year to fund that gap.
You're going to compromise your lifestyle.
You're going to compromise your lifestyle. It's about setting up that RSP or TFSA or rental property. Start it up ASAP. My other recommendation is, it's called dollar cost averaging, or a continuous savings plan. It's quite difficult to save $2,000, $5,000, or $10,000 in your checking account to actually invest it. Most of us, including me, it's difficult to do that.
Me included, yeah.
So the best way, I've seen it, I've done it for clients, is you save a little bit off of every paycheck. If you get paid weekly, bi-weekly, monthly, whatever you can afford to save, have that conversation with yourself and your advisor, and it's simply put, you pay yourself first. So as your paycheck comes in, you move your $200 automatically right to your growth fund of your RSP. You've never seen it, you never miss it, and before you know it, you start to accumulate some wealth in that RSP.
And you probably get used to not living on that money, right? If you're putting away $100 a week, say you make $1,000 a week, you get used to living on 900 when that's automatic and you don't even think about it, right?
Professionals say within 65 days, you've adjusted and you've gotten used to that amount.
Okay.
So absolutely, you get used to it pretty quick. One thing that we should talk about and we should address as well are the cons of investing in stocks. So we talked about a lot of pros of both stock market and real estate. They've kind of mimicked off each other, but knowing the cons of the cons of investing will really help you address it and really help you understand it. So the biggest thing I see with investing in stock is it's emotional investing. It's emotionally driven. Even though stocks have been proven to generate wealth over a long run, clients still get too emotional and they're still undisciplined. You end up losing money because of psychological factors. During the credit crisis, which would have been 2008, financial advisors were telling people to keep their stock, keep invested. In fact, invest more. You should be buying.
Stocks were on sale, right?
Stocks were on sale. You have to be counterintuitive. Warren Buffett has always said, when people are buying, he's selling. When people are selling, he's buying. And it's just important to understand your emotion will be in play. It's so difficult to completely strip your emotion out, but just understand it and be aware that your emotion may play on your investment portfolio as well. And the other side of it, which kind of mimics the emotion, is short-term volatility. We can see, probably even more so than real estate, we can see a lot of volatility in stocks. You can see extreme fluctuations, quite honestly. You could buy a stock for $40, and that stock may go to $10 or may go to $80. Volatility happens on the upside as well. If you know why you've owned that stock, you like that company, we've said it before, you're buying an ownership in that company likely because you believe in the company, it really doesn't matter what the stock does today or tomorrow. You want to own this stock for 3, 5, 10, 15 years out. So it really is irrelevant what the company is doing today and tomorrow. You want to hold onto your well-valued stocks over the long term. And these little hiccups, whether they're up or down, often always get smoothed out.
So the volatility is a con, but it's also a pro at the same time because you can make money on the upside of the volatility too.
Exactly. And you know, if it's and that's why we talked about your TFSA. If you have a short-term time horizon, like your first house, you're going to be in more conservative funds. And if you're in more conservative funds, that actually means a lot less volatility, because you don't have the time on your side. If, like myself, I'm 35 years away from retirement, my RSPs are very growth oriented. Today and tomorrow, they may have a lot of fluctuation, but I really don't care because I'm investing in good companies for the next 35 years. So it really doesn't matter about the day-to-day.
So if your strategy is very, very long-term, you're not going to have anxiety because Elon Musk tweets out that his stock's too high and then it tanks the next day, but then usually it recovers within 2 days, right? So those little blips aren't going to bother you because you know that you're investing for way down the road anyways. So do you notice once you take the approach of the long-term game rather than trying to day trade that the level of anxiety or nervousness goes down with it?
Yes, most definitely. It's you can sleep at night. Once you understand your RSPs are long-term, they would be more growth oriented. Again, with the age approach, they'll be more growth oriented, and you sleep at night because you're not really worried about what they're going to do from day over to day.
And I mean, if it's self-directed versus hiring a professional, a lot of times it's self-directed, right? You're going to take that onus on yourself. All of a sudden your account's way down. I'm a terrible trader. I didn't know what I was doing. And one bad news cycle could really do that to your personal account. But if I hire a professional, then there's kind of a buffer in between there too, where I might not be paying as much attention to the day-to-day activity of the market. If I can have assurance from my advisor that, trust me, it'll work out long-term, these are short-term implications.
And hiring an advisor might bring things to light that you've never even thought about. An example is correlation. If you own Tesla, Toyota, and Ford, for example, you're all in the same sector. So if anything happens to that sector, there's a good chance all three of your stocks are going to go down at the same time. So you want to have some negative correlation, which an advisor may be able to bring to a table, which individuals self-directed haven't even thought about.
So if I'm going to have personal transport, maybe have mass transport too, so that if cars go down, at least the trains or the subways or those systems are going to go up to offset it.
Normally, coronavirus pandemic, away from this, gas and airlines could be an example.
Yeah.
If gas prices go down, typically airline stock will go up, and vice versa.
Okay. Cool. Was there anything else that you wanted to touch on today?
No, I think that's great.
So anyways, guys, we've hoped that you've really gotten a lot of value out of this series, and if we get really good feedback on it, maybe we'll do some more follow-up videos in the future. But again, we do not think that there's any right answer or wrong answer. We think that the best solution is just start doing it. A lot of people get stuck in what we call analysis paralysis, where they love the idea of investing, but they're so adverse to risk that they never actually get started in it, and they end up just kicking themselves later. So if I can advise you to do one thing, it's get started, but get started small. Get comfortable with it. Enter with low risk stuff, maybe low upfront cost stuff. I think a TFSA is a great way to get started.
Right.
Talk to a professional at your bank. Have an advisor, whether you're getting into stock or real estate or whatever. Talk to people that this is what they do all day, every day. Because guess what? The guidance is going to be a little bit different when you're dealing with professionals that live, breathe, and eat this stuff than it is from your Uncle Ronnie at your family reunion. So anyways, if we can push you to do one thing, it's get started in some kind of investing, get comfortable with it, read lots of books, talk to professionals, and again, know that there's no right answer. Everybody makes mistakes along the way. They'll sell stocks that they knew they shouldn't have, or they were told not to, or maybe they put too high of an offer on a price or on a house initially, or maybe they took the first tenant that came along rather than signing the right tenant. Things like that. So people are going to make mistakes, and again, none of these are parts of a get-rich-quick scheme. They're both get-rich-slow, long-term growth, look towards retirement, and become financially free. So we hope that you've got value from this today. Carmelo, thank you for helping me out with this, and we hope that you guys loved it. Thanks so much.
Thank you.